Yeah, well, most of us aren't able to be all that nimble, and so what we do within our portfolios is try to reposition for what we expect in the next 6 to 9 to 12 months. So one of the stocks I have for you is a dividend payer. That's been a great place to be. We've been managing dividend growth portfolios since, dare I say it, 1984, and so we like the. I mean, this is not a fad for us. And AbbVie is a name that is yielding 3.6%, growing the dividend at 17% annualized over the last 5 years, only trading at 13.8 times the S&P versus the, I'm sorry, 13.8 on a price earnings multiple versus the S&P at 17 times. And investors have been sitting on the sidelines worried about the Humira off patent coming up, which we've known about for a very long time. The company's very confident they can replace those earnings with Skyrizi and Rinvoq, and they're looking for to get approval for other indications for those names. And then you've got the aesthetics business, which has been a workhorse after
Sure.
the Allergan transaction. So we like this name a lot. It's up 25% this year, but you shouldn't be afraid to step in here. You're getting paid. You can just sit back and clip the coupons, the dividends.
Sure. So before we turn then to talk about Steel Dynamics and Raytheon, why ServiceNow is your fourth name? It surprises me a little bit. Why is this name up there?
Well, I think they've been the most successful purveyors in the cloud this last year. Bill McDermott is probably one of the best CEOs in corporate America. He has argued that the secular tailwinds behind this company are much greater than the macro crosswinds, and they've delivered, earnings and revenue growth in the 20% range, and they've been able to secure really big deals and keep 98% of their customers. Their unique application of data management on the cloud puts them in an area that allows companies to save money. They gave an example on the earnings call that one client is going to save $1 billion over the next 12 months just by employing their systems. And that's important when you're in a labor-constrained environment.
Exactly, or you're looking for those cost cuts. Maybe it's a catalyst. I guess my final question, Nancy, and you must get this from people a lot who are concerned about the outlook and say, I don't want exposure to equities. I want to pull back here, maybe especially given their investment time horizon. Make your case as to why they shouldn't do that.
Well, I think to some extent they should. I mean, remember, we probably don't remember, but in August of 2020, we were saying that bonds were riskier than stocks. And so we moved our clients out of the fixed income market into some commodities, also we have an inflation strategy, both of which have done much better than bonds. Now it's about 4 or 5 months ago, we started moving clients back into very short dated ladders in treasuries, munis, and corporates, depending on their risk profile. So you now have the opportunity to have a much more constructive allocation, but equities are going to have historically outperformed 2/3 of the time. So you never want to bet against them, particularly in a high inflationary environment. So one of the safest ways to be exposed is through dividend payers, and that just happens to be our specialty. But yeah. I don't think you want to shy away from equities at all. And the last thing I'll say, Kelly, is that institutional allocations to equities are below where they were in 2008, and you've got very negative retail investors. So the odds of, at the margin, money moving back into equities is much greater than not.
All right. She's good at what she does. Nancy Tengler, thank you very much.